Hey everybody, my name is Justin, and today I want to talk about Warner Brothers Discovery, ticker symbol WBD. This is going to be a stock analysis video, and I did talk about Warner Brothers a few months ago before the merger with Warner Media from AT&T, but now that these two companies have officially merged, I want to revisit this company because it has been on my radar for probably about a year now. And to me, it looks very, very interesting. So let's just jump right into this. All right, so if we first take a look at the investor deck presentation that these companies had about a year ago now, this came out. And the merger officially went through on April 8th, so just a couple of weeks ago. And this is kind of how it was made up. So Warner Media, which was part of AT&T, kind of spun off and then merged directly with Discovery, and that's why it's called Warner Brothers Discovery now. And after the merger, essentially AT&T shareholders own about 71% of the company, and then Discovery shareholders own about 29% of the company. Now, with this transaction, that's also important to note is that there's about $43 billion of net debt that moved from AT&T with the Warner Media merger with Discovery. And AT&T, I've always liked the company, and they've always paid a really solid dividend. I think it's a pretty conservative company as far as not being too volatile overall, but at the same time, I just can't get around their debt. I mean, their debt has been close to $200 billion, so that was always a concern to me. So I think this is kind of a win-win situation where AT&T can unload almost $50 billion worth of debt, but then Discovery can actually take all the content, and you're talking, I think it's like 200,000, over 200,000 hours of legacy content between Discovery and Warner Media. And this is a juggernaut of a streaming company. And they're easily going to go head to head with these other streaming giants like Disney, for example, also Netflix. So I think this is a win-win situation. There's a lot of times I think when companies merge and one gets a better hand of the deal, but I think both companies are going to win in the end. I mean, AT&T has said that they want to kind of refocus on their legacy business around mobile phones and such. So if we take a look at some of the benefits here, obviously Warner Media, one of their biggest things that they have is HBO Max. And like I said before, they have over 200,000 hours of video content available in over 220 countries. High quality production capabilities of Warner Brothers Studio, #1 TV studio by revenue and volume. So keep in mind that Discovery before this merger was pushing around $10 to $12 billion of revenue. Now taking the merger with Warner Media, now they can actually bump that revenue up to about $50 billion. So you're talking about almost 4 times the amount of revenue that Discovery had before. They'll be able to capture 3/4 of 2022, but certainly in 2023. Top 2 movie studio by box office 11 of the last 12 years. And you can see the different content that these companies have now. Obviously, Warner Brothers, you have HBO, which is all part of Warner's Media, Sopranos, Harry Potter. But over on the Discovery side, you obviously have the Discovery Channel, TBS, HDTV, TNT. So there's some very, very popular channels and content that people are going to recognize from this. All right, so let's jump over and take a look at a stock chart real quick. And this is a 5-year chart on Yahoo Finance. And you can see it's pretty much flat. And this is basically Discovery stock price going back the last 5 years. And so they pretty much were trading around $20 to $25 the last 5 years. Saw this big uptick here, and that's because of the announcement that they were going to merge with Warner Media, and then it kind of just dropped back down. And today it's trading around $18 a share. Now, obviously, there's been a pullback in the market since the beginning of the year. Also, with the Netflix recent dive, also hurt Warner Brothers Discovery. And I did a video recently on Netflix, and I do like Netflix. However, I think they have a lot more headwinds in front of them than, say, like Warner Brothers Discovery does. In fact, Netflix lost some subscribers last quarter. Now, most of it had to do with the Europe war that's kind of going on, but they projected another 2 million loss of subscribers in the next quarter. Where if you looked at Warner Brothers Discovery, and Discovery specifically, they've actually added subscribers, and they are expecting to add more. I mean, HBO alone has added millions. I say like 3 million net ads or something like that in the last quarter or so. So very, very impressive indeed. Now, if we go jump over and take a look at, what Discovery has done historically. Now, I typically like to look at companies' 10 years worth of financials, and we're just going to look at the last 5 years for Discovery, and then we're going to talk about, where analysts think this company's going, where I think this company's going. They get into like intrinsic value calculations, and so we can see from like a sales per share, the company going from $14 to $19. And I'll show you guys a compounded annual growth rate for these measurements here in a second too. But you can see earnings has gone up, but you can see that from 2019 till last year it was kind of dipping. Operating income down, up, down. Free cash flow slowly kind of going up there. Book value has been going up overall. Took a little hit this past year. ROI, ROIC. The company hasn't done a great job as far as taking shareholder equity or debt financing and turning it into net income. I'd rather see this above 10% personally, which is off of that. They do have some debt, so they've took, as of the last year, about 5 years, it would take them to pay off their long-term debt based on free cash flow. Gross margin, so we should probably talk about this. So they've kind of been around 61 to 65%. Now, I think with this merger with Warner Media, they're going to drop down to around 45%, kind of around there. So we should see this gross margin drop. Operating income, they've been between 17 and 25%, which is pretty healthy. Net profit margins anywhere from like 6 to 20%, kind of all over the place there. As far as EV over EBIT, kind of all over from around 8 all the way up to 26. Look at PE, kind of all over the place from around 18 down to negative like 35 and up. So a bit all over the place too. And then shares, pretty much actually flat. So they kind of were buying stuff back, and then they've been issuing more shares. Now, they had to issue a lot of shares last year, or issue some of them, and also go into more debt. So they had to issue, I think, about $10 billion worth of debt in order to merge with Warner Media. So just keep that in mind. So they issued more shares and then kind of issued more debt overall as well. Now, if we take a look kind of what a 5-year compounded annual growth rate for this company has been for Discovery specifically, these are not a combination, this is just Discovery. Over the last 5 years, the sales has grown 13%, earnings has been flat, operating income has been flat, free cash flow 13% growth per year, book value has grown about 20% per year. ROE has been 10% average, 5% average for ROIC, and then debt payoff has been around 5, which we talked about before. Now, as far as what analysts think this company is going to grow, so this is a combination after the merger has taken place. This is projection from 2023 through 2026. They think they're going to grow the top line of 6% per year. I think that's kind of sandbagging it personally, especially with historically Discovery's grown about 13% on the top line per year. Net earnings 46%, operating income 11%, and then free cash flow 21%. In fact, if we go kind of look at more detail as far as what analysts think this company is going to do. So this year they think it would be around 48 billion. Last year was 12 billion. So you can see the huge jump with merging with Warner Media. And then next year it's supposed to be around $51 billion. And I think the company is projected around like 52 billion. So pretty much in line with what management has said. Now, analysts think next year there'll be around $13 billion for EBITDA. The company said they were going to be around $14 billion. So that's kind of interesting. Analysts think a little less based on that. Now, these CAGRs over here are based on from 2017 to 2026. So just keep that in mind. The analyst estimates for growth from 2023 to 2026, what we were talking before, and that's kind of these numbers right here. So, for example, like free cash flow, kind of the basis there is $5.3 billion. And that's based on kind of a base of $5.3 billion, going to grow to around $11 billion by 2026. So huge growth there overall. Even cash from operations supposed to grow 22%. per year. If we look at kind of some street targets, so right now it looks like there's about 15 analysts following this company, so quite a bit looks like overall. So there about 8 of them say it's a buy right now. 2 of them say outperform. 8 say hold, and then 1 says sell. But on average, I think the stock is worth around $37 a share, and today it's trading at 18. So according to them, it's it's 50% margin of safety. Interesting enough. Now, as far as competitors go, I just kind of showed Netflix and Paramount here. Gross profit margins, I said before, it should drop around 45%. They were 60% last quarter, kind of in line where kind of Netflix is overall. Cash flow margins, 20%. For Discovery last quarter, Netflix was 17, Paramount was 17. So we could see it kind of dip here over the next year, and then kind of, I think, tick up after that. That's kind of what I think. But from an enterprise value, I kind of wonder if this is correct or not. Saying 50 billion for enterprise value, I think it's higher than that. But that's kind of interesting there. Now, if we take a look at valuation for the company, look at 3 different valuations. First, we'll take a look at earnings per share valuation. So what I'm trying to do here is come up with a good earnings per share and then project out over the next 10 years what I think the earnings per share is going to be, and then discount it back to today's value to get to what I think the company is worth. And so I come with $1.25 for earnings per share. So you might ask, how I get to that. And I get to it right here. So what I'm doing here is trying to look at operating earnings. I'm not sure exactly where they're going to fall out as far as net income goes. And 2022 is going to be weird. I think they're going to have a lot of merger costs. So it's going to be just, I think it's going to look bad on the bottom line. Let's put it that way. So I'm trying to look at operating earnings, so it kind of removes some of those one-time adjustments we'll see from the merger that's happening. So what I'm assuming is that there's going to be around $3 billion of EBIT for this year, and there's about 2.4 billion shares outstanding. So I'm coming with around $1.25 for a good EPS for this company. So that's kind of where that's coming from. And then growth, I go with 11%, which is pretty similar to what analysts think they're going to come at. In fact, if we go back, they're saying operating income is going to grow under 11%. So trying to kind of be conservative there. In fact, if we look at EBIT, they think even next year it's going to be around $3 billion. So I don't think, at least when I look at it, I don't think it's going to grow very much from this year to next year, just because of all the stuff that's going on. You have to got to keep in mind, I think there's going to be a lot more costs even on the top end of the P&L too. When you're trying to merge 2 companies and you're trying to get them in line with each other. In fact, the company I work for went through an acquisition a few months ago, and so I'm learning that as well too. It takes a lot of time for 2 companies to kind of sequence and kind of merge together and kind of, I guess, harmonize. I guess it might be the best word. So I'm coming with $3 billion, so that's kind of where I get that $1.25. Now, as far as a payback time goes, this is a Phil Town calculation. I took Phil Town's investing course a couple of years ago. I have a lot of respect for the guy. And what we're trying to do here is come with a good free cash flow growth over the next 10 years. So I'm coming with 15%. Analysts think it's supposed to be around 22%, kind of running there over the next 5 years. So over the next 10 years, I'm saying 15% with a free cash flow base of $4.5 billion. So based on that, I come with a payback time of 6 years, which is actually less than the 8 years that I'm looking for. So that is fantastic. So that's telling me I get my money back in 6 years. That means I probably, or there might be a decent chance I could beat the market by a 2x during that time frame. And then if we look at a discounted free cash flow model as well, so I'm kind of doing the same thing, basically 15% growth over the next 10 years. So 20% 1 to 3 years out, 15 4 to 6 years out, 10% 7 to 10 years out. I'm using a discount rate 15%. I usually do 10%, but I feel that there's just a lot of moving parts here, especially with a new merger. I just want to be more conservative. So I'm going to use 15% as my discount rate, 16 as the multiple. I'm using a net debt number of 50 billion. It's between 50 and 60 billion. So I'm using 50 billion. Might be right, might be wrong, but that's what I'm going with. And so I come with an intrinsic value of roughly $27. Now, if I use a discount rate of 10%, which I normally do, it'd be around $50. So take it for what it's worth, but I'm using 15 just because I'm just trying to use a bigger margin of safety because there's just so many assumptions that are going on. I mean, you're taking imperfect numbers, right? You're taking either your own calculations or analyst calculations, and then you're using also compounding the issue with using some kind of growth rate, which is probably imperfect as well. So you're coming with an imperfect intrinsic share price. So looking for kind of more of a cushion, a margin of safety is kind of how I'm looking at that there. So yeah, I mean, it's kind of interesting. So from an earnings per share standpoint, I think it's worth around $30 a share. Payback time within 6 years, that's fantastic. Discount of free cash flow around $28. Churn at $18, that's a 35% margin of safety. EPS was around 40% margin of safety. So it's not very often that I do all three of these calculations and come up with, intrinsic value that is lower than what, or excuse me, higher than what it's trading at. That there's actually a margin of safety, and so becomes very interesting to me. Now, obviously, there's a lot of risk, especially with the debt. I'm very debt averse. So when I see a company that has $50 billion of debt, that's a ton of debt. Now, according to Charles Schwab, they're on a $55 billion enterprise value. I think it's higher than that. So if that indeed the case, that means they have the same amount of debt as they have as market cap, which is a bit concerning. But the company is saying that it should be around a $14 billion of EBITDA in 2023. Analysts think around 13 to 14 billion. That they should have enough money to start paying down some of that debt. And I would think as this company grows, as they kind of synchronize and harmonize, they might be able to get to a point where they actually have a dividend as well, or maybe they're buying back shares. But I hope they start paying down the debt. I want to see them doing that first. So I'm very interested in this company. I really think that I think they have a bright future with over 200,000 watch hours, more than any other streaming company that is out there. They have some big brand names from HBO to Warner Brothers to HGTV to Discovery Channel. So I think they can easily compete with a lot of these other streaming giants. And it kind of feels like Netflix is kind of going one way where they've kind of hit the top, and now they're kind of starting to lose subscribers and trying to scramble and try to kind of change. Kind of not necessarily their business model, but kind of focus on different things that they haven't focused on before. For example, trying to maybe do a different tier structure or charging people extra money for having, an extra login or whatever the case may be. Where I feel like Warner Brothers is kind of coming in a situation where they have a lot of growth ahead of them. At some point, they're going to max out, but I don't think that they're there, and I think they're going to do very well. And I think with the network moat that they're going to have, I think it's really going to create some value for shareholders. So yeah, very interesting. So I'd love to hear from you guys. I mean, what do you think about this company? Are you interested in it? Are you not interested in it? I'll throw this out there as well. So this Excel workbook that you guys see me use here, I offer that to my patrons. They also get access to my Discord channel as well, along with my valuation template. So if you're interested, I'll put a link down in the description below for the Patreon. And so thank you so much for watching. I really appreciate it. I'll catch you guys on the other side. Take care and God bless.